Okay, welcome. My name is Kyle. I'm here with Tintin and Captain Haddock, and today we're going to go through an e-tutorial on solving problem S14-2 from your textbook. So I don't think this problem is found in the workbook, it's in the actual textbook. So Snowis Corporation has 10,000 common shares outstanding. Snowis distributes a 20% stock dividend when the market value of its shares is $18 per share. Requirement number 1 is to journalize Snowis declaration of the stock dividend on September 30th and the distribution of the stock dividend on October 30th, 2020. There are no explanations required. Okay, so before I actually solve this problem, I'm going to go through a little bit of a quick review of what we know so far. I'm going to summarize some accounting 1030 material as well as some 1040 material that we did specific to partnerships and to proprietorships. And I'm going to pull up the acronym REID. So we know revenues and expenses close to income summary. And then income summary and draws close to capital. Now this was for partnerships and proprietorships. When we're talking about corporations, we no longer use the term capital. Instead, income summary closes to what's called retained earnings. And so retained earnings is really the accumulation of net income since the beginning of time for a corporation. But we had REID, the D, when we were talking about proprietorships and partnerships, referred to owners' withdrawals. With a corporation, dividends are kind of like owners' withdrawals. The board of directors will declare a dividend and distribute dividends to the owners out of retained earnings. So dividends come out of retained earnings. They come out of the accumulated net income, which is called retained earnings. So that's a quick 60-second review on what we know. Income summary, so net income of a corporation closes into retained earnings. And then dividends for a corporation, remembering dividends are a distribution of cash or stocks to owners. They're paid out of retained earnings. So since retained earnings appear in the equity section of a balance sheet, they're permanent accounts. They accumulate, they don't reset to zero, just like income statement items do. And if I make this clean for us again, okay. I'm going to just give ourselves our little DC Adler cheat sheet. So DC Adler. Debit, credit, asset, draw, expense, liability, equity, and revenue. So retained earnings is an equity account. And if I'm paying dividends out of retained earnings, what I'm going to be doing is reducing my retained earnings equity account. So since it's under the credit side, remembering this shows the normal balance, so what it will take to increase that account type. If I'm paying retained earnings in the form of dividends to the shareholders, I'm not increasing retained earnings, I'm decreasing it. So I'm going to do the opposite of what's laid out here. Now going back to this question, what is it actually asking me to do? I need to journalize the declaration of the stock dividend. So remember, dividend is going to be distributed, a cash distribution or a stock distribution, but they were declared on September 30th. So we know as soon as there's a declaration of dividends, we have to do a journal entry for it. So on September 30th, I know I'm going to be reducing retained earnings, and I reduce it by doing the opposite of what's in this chart, and therefore I'm going to be debiting retained earnings. How much am I going to be reducing it by? Well, there's 10,000 common shares outstanding, there's a 20% stock dividend, and they're $18 per share. So 18 per share multiplied by 10,000 multiplied by 20%, and that's going to equal something. I'm not going to do the math in my head. My brain is far too small for that. So $18 times 10,000 times $20 times 18, sorry, per share, or 20%. It's going to be $36,000. So that becomes our debit amount, 36,000. So hopefully everybody's with me on that. It was 10,000 common shares, the number of shares outstanding. There's going to be a 20% stock dividend at a price of 18 per share. And I calculated all of that down here. Let me just make it clean for us so we can proceed. So if these dividends are coming out of retained earnings, what's actually happening right now? Well, on September 30th, it was the declaration. The distribution didn't happen until October 30th. So what we actually have here, the credit isn't going to be to common shares because the shares haven't been issued yet. The shares are going to be issued. So it's going to be a common stock dividend distributable. It's going to be also in 36,000. So we've done now with the September 30th journal entry. Now let's fast forward to October 30th. We actually need to do the distribution. So what we need to do on October 30th is reduce this dividend distributable to 0 and reflect an increase in the number of common shares outstanding. So when we reflect the increase in the number of common shares, we're actually going to increase the book value of the common shares, and that's what our credit will be. So first, though, to reduce this to 0, I'm going to be debiting that account, 36,000, which reduces it to 0. And instead, because we're actually issuing the shares now on this date, I'm going to be crediting common shares. So this is going to increase the book value of the common shares outstanding on the balance sheet, 36,000. Now we're done with requirement number 1. Requirement number 2 asks us, what is the overall effect of the stock dividend on Snow's total assets or on shareholders' equity? So to do this, what I'm going to do is I'm going to write down the fundamental accounting equation, assets equals liabilities plus shareholders' equity. So what is happening here? Let's think about this critically. Is there any impact on cash or on any of the assets? Well, the answer here is no. Is there any impact on liabilities? Well, the answer here is no. And what's happening is, well, here, the number of common shares is increasing. Yes, the book value of common shares is increasing, but that came out of retained earnings, which is decreasing. So there's no impact on shareholders' equity as well. And that's our quick little tutorial on S14-2. Thank you for listening. My name is Kyle. Have a great day.